wishes come true. Believe it or not, I'm walking on air. I never thought I could feel so free. Good morning, everybody. Happy Monday. It's March 17th, 2025. Great to be with all of you, and happy St. Patrick's Day. So we're getting off to a little bit of a rough start this morning, although the futures have battled back here. We just had the release of the February retail sales numbers, which were somewhat mixed, somewhat good on the autos and gas side. They were a little bit better than expected, but on the overall month over month came in a little bit lighter than expected. I could show you that these numbers right here. Let's take a look at that. As you can see right here, core retail sales came in line, 0.3. Retail control, actually much better than expected, 1%. And then again, here's the numbers for retail sales year over year, and then month over month, 0.2 versus 0.6 expectations. That was a disappointment, but the retail sales ex gas a little bit better than expected. So, some mixed numbers here. So a little bit later on this morning, we'll have business inventories and cap utilization, and then a couple other numbers from Europe, and then ECB President Christine Lagarde will be speaking about 10 o'clock in the morning. Don't forget, tomorrow is going to be the start of the second Fed meeting of the year. They will be sending out projections again at the end of the meeting when the statement is announced at 2 p.m. Eastern time on Wednesday the 19th. So following that, obviously, is a press conference with Chair Powell and a whole bunch of reporters as well, too, talking about the reasons for what they did. By and large, the Fed funds futures market and most of the consensus economists believe that the Fed will stand pat on interest rates this time around, probably keeping rates at 4.25% to 4.5%. The Fed funds futures market is anticipating or optimistically looking for 3+ rate cuts in 2025. I just don't see that happening. I think one rate cut at this point in time seems rather generous by the Fed by the end of the year, but that would only bring you down to about 4%. Still moderately restrictive policy from the Federal Reserve with monetary policy. So I think for the Fed to start moving on interest rate policy to the downside, you're going to have to see several months, not just a few, but several months of inflation either stopping their rise and then starting to head down in combination there together. Probably, I'd say 4, maybe 5 months worth of data in that direction. So last week's CPI number was a little bit market friendly. Markets didn't take it too well. We also saw the PPI number, which came in also very market friendly. We saw a negative number on the PPI number on the headline. So that was good in terms of bringing the inflation on the at least on the core side to the downside. So again, somewhat mixed here with these retail sales numbers. We have some earnings coming out this week, namely from some big names like FedEx, Accenture, Nike as well too. Will be reporting later in the week. So we want to find out what they're having to say, certainly about the consumer. There's been some worry that the consumer is somewhat slowing down. We did see poor retail sales in January, and again, back-to-back poor numbers in January and February. And we also saw spending numbers when the PCE number was released a couple of weeks ago. That was weak as well too. So the economy is driven by 70%, 70 to 8, almost nearly 80% by the consumer, service sector and sales and retail. So if that's slowing down, we do have a shift in the economic assumptions that the economy is growing at full potential. So what does that mean? That means that perhaps the economy is growing below potential. And if that being the case, and if inflation starts to weaken, we may have a move down in inflation and in interest rates as well too. So let's take a look at a couple of charts before we head on into some other stuff here. So let's take a look at certainly the futures have rebounded. Now we're on the plus side. Very nice. Up about 7 points. Nasdaq up about 57 over here. S&P 500. Take a look at this over here. So we did have a big reversal on Friday, and what we're looking for, folks, is a higher high and a higher low today. That would be what's called a follow-through day. You hear Tony in the background whimpering here. That would be a follow-through day to the upside, and meaning that this index has a chance to get back to where? The 200-day moving average, and that's about 57.55 on the S&P 500. We closed Friday at where? 56.38. So that would be a good 120 handle move to the upside before maybe possibly running out of steam. And so I wanted to put this trend line here. We see that this move down has been pretty sharp and steep, and that trend line kind of comes, if you connect these three tops over here, that trend line comes down to where? Right to the 200-day moving average. So if we get a quick move up there, we could get a move up there, bounce back here, maybe down over here, come back down and test near the lows over here. It's going to take a while to build a nice base over here. If we get a wild move to the upside, we get a big reduction in volatility. Again, that would be positive for the markets. If we get that big move up there, past the 200-day moving average, it makes this market move vulnerable to some more downside. So I just be cautious about a very, very fast move over here. How do those market move? The market moves when people are skeptical. They're worried about markets moving up or moving down. We call that climbing the wall of worry. So if that wall of worry is up nice and high, then we could possibly see some more upside when there's a lot of doubt that the market can move higher. Now let's take a look at one of these breadth indicators that I like to talk about. This is the Nasdaq new highs, new lows, and we can see the damage that this indicator has done to this market index over the past month or so. And big negative readings over here are not positive, right? So frankly, with the move in the Nasdaq to the downside, a little bit of a correction down 10%. Maybe that's over. If we get some readings to the positive side, we get above zero. That would be very positive for the markets, and we might get some upside as well from that. So that's going to be it, folks. I'm going to lay it down right there. Have a great day. Have a great trading day. If you're in the chat room, I'll see you there a little bit later on today. Thank you very much for listening today. Hopefully we'll have some more stuff on Thursday. We'll be talking about the Fed meeting, talking about some of the other data that's going to be coming out as well too, some earnings, and hopefully we get some really good movement here. What I would suggest you do, just take things slow, keep some protection on, keep your cash levels high, and if you see some opportunities, go ahead and take it slow. Don't jump in with both feet. Just dip a toe in and take some action. And if things start moving in your favor, then you add a little bit more. Take some profits and wash, rinse, and repeat. That's it. Have a great day, everyone, and I'll see you guys all on Thursday morning. Take care. Bye.